Stop scrolling. Seriously, put the phone face down, close every tab, and give me 5 minutes of uninterrupted attention. Because the story everyone is obsessing over is not the story that matters. Yes, you're seeing silver trade in the low to mid-90s on Western screens. Yes, you're seeing a double-digit premium show up in parts of Asia. And yes, you're watching the usual crowd argue about charts, trend lines, and whether it's overbought. But the real shift is not technical, it's structural. Over the weekend, language tied to US strategic procurement and critical materials replenishment started circulating across defense and supply chain circles. Language that reads like the quiet beginning of something much bigger. A sovereign buyer preparing to step into the physical silver market not as a speculator, not as an investor, but as an end user with national security urgency. And when a buyer shows up who doesn't care about price, who cares about delivery, every rule changes. Because most players in this market are optional. They can pause. They can rotate out. They can switch to another trade. A strategic buyer can't. That's why today is not about silver going up. It's about silver changing categories from a tradable commodity to a protected input, from something people want to something systems require. If that sounds dramatic, good, it should. Because the physical market for silver is smaller, tighter, and more fragile than most people realize. It does not take trillions to break it. It takes a sustained price, insensitive bid colliding with already stressed inventory. So here's the roadmap for this video. 7 parts. No fluff. We're going to walk through what this rumored procurement shift actually implies, why futures inventory math is flashing red, why East vs West pricing is a magnet that drains metal, why retail supply is the canary, why the calendar matters more than opinions, how a papered physical split can happen, and what a rational, non-panic plan looks like. Let's get into it. First, let's talk about the new buyer, because this is where people get it wrong. When a hedge fund buys silver, it's a trade. When an ETF buys silver, it's a flow. When a retail investor buys silver, it's a personal hedge. But when a government procurement program buys silver under critical materials framing, it's not a trade. It's logistics. It's stockpiling. It's continuity planning. It's we need this material available regardless of market conditions. That difference is everything. A normal buyer has a ceiling. A strategic buyer has a mandate. And if procurement language is real, and if it's tied to replenishing a national stockpile, then what you're looking at is not a one-time headline. You're looking at a new, recurring source of demand that can expand the moment the market tightens. Now, people will say, governments do this all the time. Not like this. Not into a market where above-ground deliverable supply is already thin relative to paper claims and industrial pull. Also, silver isn't just a metal. It's embedded in systems that governments care about: electronics, communications, certain defense components, power management hardware, and a long list of industrial applications where substitution is slower than headlines suggest. So the question becomes, where would that metal come from? Not from a magical hidden pile. If a sovereign buyer wants immediate delivery, they can't just point at global annual mine supply. And wait, they need bars now. That means they compete in the same real-world channels as everyone else: exchanges and their warehouse systems, refiners and fabricators, and the limited pool of ready-to-move inventory. This is where the market flips from price discovery to inventory discovery. The price on a screen becomes less important than the answer to a simple question: can you actually get the metal? In size, on time, in the form you need, and once that question enters the market's bloodstream, it spreads. Industrial buyers don't sit around hoping the problem resolves. They front-run. They lock supply. They sign longer contracts. They pay up to protect production. That's when a shortage stops being a theory and becomes behavior. So if you've been wondering why the tone around silver feels different lately, why every dip gets bought, why premiums don't relax, why spreads appear and refuse to close, it's because the buyer mix is changing. And the moment a sovereign mandate becomes part of that mix, every short seller is no longer betting against investors. They're betting against national procurement. Now let's talk about the part nobody wants to talk about: the futures to physical pressure. A functioning futures market relies on one key belief: most people will cash, settle, or roll. The system is built for that. It can tolerate delivery, but only within a certain band. When deliveries surge outside that band, especially in months that are typically quiet, that's when the market starts to look less like a marketplace and more like a stress test. And lately, the delivery behavior has looked aggressive. Not normal high, not seasonally strong, aggressive. Like the kind of demand you see when participants don't trust future availability and prefer metal over money. If you're new to this, here's the simplified version. Open interest is paper promises. Registered inventory is the slice of metal that's actually positioned as deliverable. The moment too many participants insist on converting paper into metal, the exchange has to manage the mismatch. And yes, there are mechanisms: eligible viz registered, incentives, exchange for physical, cash premiums, private deals. But none of those mechanisms create new metal. They only shuffle claims. So what matters is the trend. Is deliverable inventory rising or bleeding? When registered supply drifts down toward the low end of its historical range, and delivery demand stays elevated, the system becomes sensitive to any external shock. And what external shock did we just discuss? A potential multi-billion strategic procurement bid that doesn't care if price jumps. That's why this is not just bullish, it's destabilizing, because the people who are short don't just need price to go down. They need liquidity. They need the ability to source metal or roll positions without triggering a chain reaction. And if large players are consistently taking delivery, especially the kind of players who tend to have deep relationships, deep pockets, and deep strategic reasons, then you're watching inventory migrate into strong hands. The market can survive high prices. What it struggles to survive is disappearing float. Here's the psychological flip once participants believe delivery is the point. Every contract becomes a potential claim on scarce inventory. That changes how people behave. It changes how banks hedge. It changes how industrial users plan. And it sets the stage for the next piece: global price dislocation. Because if one region is signaling scarcity with higher physical pricing, and another region is still anchored to paper, metal doesn't stay put. It moves. Let's go east. When you see a persistent premium in Asian pricing relative to Western paper quotes, that is not just a fun trivia fact. It's a directional force. Think of it like water pressure. Metal flows toward the higher realized price, especially when the spread is wide enough to pay for shipping, financing, insurance, and still leave profit. And when that spread is not a few cents but a meaningful, attention-grabbing gap, it does two things: it incentivizes arbitrage, and it exposes which price is more connected to physical reality. Now, it's not always simple. There are rules, taxes, quotas, exchange constraints, product specs, timing issues. Arbitrage is never as effortless as social media makes it sound, but the macro effect is still real. A higher physical bid in one region pulls supply away from the lower bid region. So if you're sitting in the US, watching a quote on a screen and wondering why it doesn't reflect reality, it might be because the reality is leaving. And here's where it gets uncomfortable. Regulators can try to cool markets with position limits, margin changes, warnings, or administrative pressure. In a normal speculative spike, that works. In a supply-driven squeeze, it can backfire because it signals fear. It tells the market, we are trying to slow the buying because availability is tight. That becomes confirmation, not deterrence. And confirmation creates the behavior that breaks markets: hoarding by industrial users, pre-buying by manufacturers, and long-term contracting that locks up forward supply. Once that happens, the West can keep quoting a number, but the number becomes less relevant to procurement decisions. Buyers stop asking, what's the spot price? And start asking, can you deliver? And what's the lead time? That is a different world. And in that world, the exchange becomes a cheap sourcing channel until it can't deliver at scale. Then it becomes a cash settlement machine with a reference price that increasingly diverges from street reality. That brings us to the ground level signal that people ignore until it hits them directly: retail availability. Retail's not the whole market, but it's the loudest alarm. Because retail doesn't have clever financing structures. Retail doesn't have private offtake agreements. Retail doesn't have a metals desk calling 3 refiners and arranging a swap. Retail has a checkout button. When retail availability fractures, when websites go backorder, when shipping times stretch, when minimum order sizes jump, that's not just demand. That's bottlenecks colliding with scarcity. And recently, multiple dealers have hinted at exactly that kind of stress, and usually high order volume, fabrication constraints, and trouble sourcing blanks or feedstock at predictable terms. Whether a specific memo is real or exaggerated isn't even the key point. The key point is the pattern: when demand spikes, mints and fabricators need raw input. When raw input is tight, they can't ramp fast. When they can't ramp, they ration. Rationing can look polite at first: minimum order, limit per customer, delayed fulfillment, certain products unavailable. But it escalates, because once a dealer chooses to prioritize high-value orders, smaller buyers get pushed out. And once smaller buyers get pushed out, they panic, because they interpret it correctly as scarcity. Then you get a loop: scarcity rumors, higher demand, tighter inventory, harsher rationing, louder scarcity rumors. This is why retail matters, even if it's not the main driver. It amplifies sentiment and accelerates the run. Now layer that on top of what we already covered: elevated delivery behavior in futures, regional physical premiums pulling supply, and the possibility of a strategic buyer stepping in with a mandate. At that point, the calendar becomes the weapon. Because futures markets don't stress randomly. They stress at specific points: major delivery cycles, contract transitions, and periods when large open interest can convert into physical demand. So let's talk timeline. Markets love narratives, but markets break on schedules. Delivery months matter because they force decisions: roll, close, or take metal. When the market is calm, most participants roll. When the market is tight, and when a regional premium makes delivery economically attractive, more participants lean toward taking metal or demanding better terms. Now combine that with shrinking registered inventory and rising, need-driven demand. The system becomes vulnerable to a single trigger: too many delivery demands at once. What happens then? 3 broad paths: the price rises sharply to ration demand and attract supply. The exchange offers cash premiums to encourage settlement without delivery. The exchange uses contractual flexibility to protect the system, up to and including forced cash settlement under extraordinary conditions. That last one is where people start throwing around big scary phrases like force majeure. Here's the sober version: contracts are written to keep the system alive. If physical delivery becomes impossible or destabilizing, the system will choose survival over purity. And if you are holding paper, expecting guaranteed metal in an environment where metal is being hoarded, exported, and strategically procured, you must understand the risk that your silver exposure becomes cash exposure at the worst possible moment. Because the nightmare isn't simply silver goes up. The nightmare is silver goes up and you don't have it. A paper payout at yesterday's reference price is not the same as owning metal in a market where availability has become the premium. This is also where a permanent paper physical split becomes plausible: a screen price that reflects managed settlement and a real-world price that reflects scarcity and delivery urgency. If you've ever wondered how two prices can exist at once, that's how one price clears paper claims, the other clears physical supply. Now we land the plane. What do you do with this information without turning into a conspiracy addict or a panic buyer? You build a plan that assumes volatility, respects counterparty risk, and avoids all or nothing thinking. Here's the actionable framework: calm, rational, and built for the real world. First, separate silver the trade from silver the asset. If you're trading, accept that paper markets can change rules, widen margins, and cash settle when stress hits. If you're hedging long-term, prioritize minimizing counterparty risk over maximizing short-term gains. Second, think in layers, not absolutes. You don't need to go all in to take this seriously. You can scale, you can dollar cost average, you can split between some physical, you can actually take possession of some liquid exposure, you can exit quickly, and enough cash buffer to avoid becoming a forced seller. Third, avoid the two classic traps. Trap A is waiting for the perfect dip in a market that's signaling scarcity through premiums and lead times. Trap B is panic, buying whatever is available at any price without verifying authenticity, delivery reliability, or total cost. Fourth, understand what you're paying for. In a tight market, the premium is not just dealer greed, it's fabrication, sourcing friction, shipping, insurance, and most importantly, immediacy. Immediacy becomes expensive when everyone wants it at once. Fifth, keep your eyes on the indicators that matter more than opinions. Registered inventory trend, delivery activity relative to normal seasonality, sustained regional premiums, and real retail lead times across multiple dealers. Now, final thought. If a sovereign strategic bid is truly forming, this won't play out like a normal bull run. It will play out like a tug of war over a shrinking pile of deliverable metal. And in that kind of environment, the question isn't, can silver go higher? The question is, who gets the metal when everyone wants it at the same time? That's the game. That's the rule change. And that's why the next few months, especially around major delivery cycles, deserve your full attention. This is not financial advice. This is a risk briefing. If you want, I can also turn this into a tighter, punchier on-camera version with timestamps, beak roll cues, and a stronger hook for retention, still fully original.